Volatility in mortgage interest rates still remains the word of the week. Let's go ahead, let's dive in and see what happened to mortgage interest rates this week across the United States right after this. Well, welcome back after the break, everybody. Again, Mike Petras here, your star realtor of Star and the Treasure Valley. And as I mentioned before, volatility is still the word of the week when it comes down to the markets and the mortgage interest rates that you might be looking at if you're looking to purchase. So the general consensus still is that everybody is on pins and needles. They are still waiting for more economic data. And of course, what is going to happen when the Fed meets on the 21st? What are they going to do with the federal funds rate? And how much are they going to raise it by? I think at this point, everybody knows that they're going to raise it. It just depends on how much. So the first report that everybody's waiting for is going to be the CPI, or basically the Consumer Price Index, or the inflation report, which is going to hit on September 13th, so this upcoming Tuesday. And then the Fed is going to go ahead and meet on the 21st and 22nd, and they're going to go ahead and decide what they want to do. Are they going to raise the federal funds rate by 0.5 point or 3/4 point? I'm going to say that they're going to do it. It just depends on how much they are going to do it by. And so that's really going to be the volatility that we are going to see probably continue, and really has been the wackiest volatility that we've seen in the last 6 months, ever since some recordings on some of these sites have been. So we just got to wait and see what they're going to end up doing, and have to deal with the volatility in the meantime until they do. So let's go ahead and let's dive into that data, and let's kind of figure out this a little bit more in depth. All right, so let's go ahead and let's dive in, and let's take a look first off with the economic reports that have jumped in for this week. And of course, a lot of the members of the Fed ended up speaking, including Jerome Powell himself. Now, did Jerome Powell have anything really interesting to say in terms of any predictors of what the Fed is planning to do in their meeting? Not when he spoke at Cato. No, he did not. So, but what he was addressing was certain things like going to digital money, which honestly I think would be bad for us all. Just personally thinking, because that's just kind of very intrusive into our lives. But again, that is up to your prerogative in terms of what you want to think about it. But he basically kind of ran away from the question and said, well, that's really up to Congress and the executive branch to be able to go ahead and figure. But that really kind of does not apply to this discussion. What I just want to go ahead and mention is just a couple of these reports. Like, first off, the ISM Services Index, which came out Tuesday, September 6th. We could see that we're still above 50%, which is saying that even the services, here in the United States are healthy, even though Jerome Powell had said that still we have a shortage in the labor market, considering that our markets are still strong. So we're just going to have to go ahead and iron that out and see what is going to happen with these indexes as it goes along, and as more or less the recession starts to kind of take itself some hold. But right now, that one is a positive sign that the economy is still doing good. The other one that I wanted to talk about was Jerome Powell. But of course, I already kind of mentioned he really did not give any clues in terms of what the Fed plans on doing. But one of the other ones that I wanted to take a look at here was going to be the Consumer Credit Report, which came out yesterday at 3 p.m. We see that the overall credit that people were taking out back in June was sitting at about 39 billion, and we can see that it's definitely gone. It has gone down. There's still $24 billion worth of new credit that was issued out to Americans across the U.S., but not as much as we saw in June. So maybe some of their policies are finally starting to take hold to be able to quell the demand here, and maybe even cap this inflation rate. So now let's go ahead and dive into the figures. First off, we're going to take a look at the 30-year UMBS, or Unified Mortgage-Backed Securities, still sitting at a 4.5 coupon. But we have noticed that it's kind of more or less gone up and down, but mainly in the direction. Tuesday, we saw a really, really big dive overall in the overall price of the UMBS. We saw it dump we saw it dump 3/4 of a point, really. And the interest rates, of course, as we know, when the price of the UMBS goes down, the interest rates are going to go up, and then vice versa. When the price goes up on the UMBS, we can expect the prices on your mortgage or the mortgage interest rates to go down. So if we're going to go ahead and scroll down, let's just go ahead and take a look. They did include the second, just kind of rolling it over on what happened on Friday, because of course Monday was Labor Day. But if we're taking a look at the second, we know that the price went up 41 basis points, which was good because it ended up lowering the overall mortgage interest rate. But there was that whopper that we saw on Tuesday of where the price of the UMBS went down 78 basis points, which rose up the interest rates. And then we've just been kind of doing a back and forth really kind of all week. But if we're taking a look at this across the week, rates have kind of been more or less the loser as we've been seeing the mortgage interest rates go up. In fact, actually, on the 6th, we got back down or back up to, I believe it was like 6.25 or 6.27, which was just shy, really, of what we saw back in June when the levels hit 6.28. So the highest that they had been in 14 years. So we do see that we have gotten some flip-flopping. And even today, if we're looking, we've gone down 6 basis points. Lowering, so we can expect the mortgage interest rates to probably raise up come Monday. Right now, for a 30-year fix, they are sitting at 5.97, but I'll go ahead and cap that off here in the end, or here in our summary in just a second. But if we're looking at the 15-year UMBS, again, the same thing. Today, it is down 31 basis points. So again, when the value goes down, interest rates go up and vice versa. And if we are taking a look here over across the week, the big hit on the 15-year UMBS really hit on Thursday, which was yesterday. It went down 72 basis points, but we see on the 6th, it went down 20 basis points. Got a little bit of relief on Wednesday when it went up 38 basis points. And then today, the 15-year UMBS is also taking another shot. So overall, in the overall value of the UMBS for the 15-year, we could see that it's mostly taken a hit, which we can expect the interest rates on a 15-year mortgage to go up. So let's go ahead and let's take a look overall. Today, the 30-year fix is sitting at 5.97%, which is down again 4 basis points or 0.04% today. And over the week, actually, they're saying that it went down 5 basis points or 0.05% over the week. But over the month, we can see that it's definitely shot up over a 0.5 basis point, sitting at 0.62%. The 15-year fixed is sitting at 5.26% today. We can see today it went down 0.03% or 3 basis points. We saw this week overall the same trend, but overall over the month, it has gone up almost a 0.5 basis point, sitting at 0.47%. So they have shot up over the month. 30-year FHA is sitting at 5.38%, which today is down 0.02% or 2 basis points. But over the week, we see that the FHA has got up 0.06%, which is 6 basis points. And over the month, we can see that it's sitting at 0.63, so over a 0.5 basis point overall. The 30-year jumbo is sitting at a 5.05, down 0.03%. Over the week, down 0.07%. And over the month, up 0.30%. 5-in-1 ARM is sitting at 5.95%, down 0.01% on the day, down 0.05% on the week, but up over the month a 0.5 point. And then lastly, the 30-year VA loan is sitting at 5.42%, down 0.03% today, but up over the week 0.04%, and up over the month 0.64%. So now let's go ahead and let's dive in and take a look quickly at what happened with the treasuries, the 10-year and 2-year treasury specifically over this last week. And as we can see that the yields at the beginning of the week were definitely up as bond prices were generally dropping, because we know that that's going to be an inverse. as the prices of the bonds drop and people duck out of the bonds. We know that the yields will go up in order to be able to attract more people back into the treasuries. So in this case, if we're looking across Monday, we noticed that the yields were high, and there is a correlation. I mean, even though there is a difference sort of between the UMBS and the 10-year treasury yield, we do notice that when the yields go up, generally interest rates on your mortgage is going to go up with them. The UMBS kind of has that correlation. But we saw, over Tuesday and Wednesday, Tuesday in particular, we saw the bond prices starting to rise, which was lowering the yields. And then Thursday, we saw that correction to where the prices of the bonds were actually starting to dump out again. And then today, Friday, we're kind of seeing that too, as the price change today on the bond went down 0.21 or 0.22% basically, or 0.23% price change. Sorry about that. On the day, which is going to raise up the yield. So we can kind of expect, mortgage rates again to kind of follow suit. Now, if we're talking about the stock market, of course, we know that usually when the stock market's not doing so hot, people will generally, give their money into the bond market to where it's more safe, and especially these treasury yields, because it's backed by the full faith of the United States government. So what we did see earlier in the week, really with the stock markets, is they were taking some hits. So I kind of anticipated, people being able to run back into the bond markets. But which is kind of, interesting today and over the last few days, is that the Dow Jones, the NASDAQ, and the S&P 500 have been doing actually quite well. But we're also still seeing, that the prices of these bonds are starting to tick down. Which is just meaning that maybe people are, putting their money back into, say the stocks as per se the bonds. So let's go ahead and move over to the 2-year treasury yield. Today it is up. We've also seen the price change go down today, which is going to raise that yield. But again, same kind of thing. Started, decent on Monday. We had the price of the bonds go up basically on Tuesday here, and Tuesday, we saw the prices of the treasury yield actually lower, which was kind of, flatlining or kind of remained unchanged throughout that Tuesday. Wednesday, we saw that the prices on the treasury yields went up. So we saw the yields kind of come down, flatlined again on Thursday, yesterday, and today we're seeing the price change has gone down 0.1406%, and the yields have gone up with them. Very sorry if I got my days a little bit on the backward end. I did more or less kind of forget that Monday was Labor Day. And if I did say that, things on Monday, was, on the 6th, then I apologize about that. This week went ahead and started on Tuesday. And I hope that everybody out there had a great Labor Day weekend. So what can we kind of expect if the Fed is going to go ahead and raise the federal funds rate, which everybody has been, anticipation of, and that's why they're really kind of still on pins and needles, is what to expect is, especially in the short-term treasuries or the short-term treasury yields, the federal funds rate really kind of generally hits it a little bit more than, say, like the 10-year treasury yield, even though the 10-year treasury yield will still feel the effects of the federal funds rate. So if they do raise it, 0.5%, that might kind of indicate to people, well, hey, maybe our economy is doing a little bit better. So they'll go ahead and we can see that the treasury yields or the price of the treasury bonds might actually kind of go up, which would lower down the yields a bit, which is good in relation to mortgage interest rates. But if they go up another 0.75 basis points, or another 75% or 0.75% in the federal funds rate, we can see that in the correlation, when they're running up the federal funds rate at an aggressive rate, we can actually see the bond prices go down. And in relation, when the bond prices go down, we will see the yields go up, which can inversely not be so good for mortgage interest rates. So we're just going to have to wait and see, and hence the volatility across the board. Now, do I think that the Fed is still doing what they need to be doing in order to tackle inflation currently? And honestly, I'm just still kind of not seeing to where a recession is not going to be in the future in itself. And of course, as we know, when a recession hits, historically the interest rates on your home mortgage is going to go down. So if we're taking a look at just like say today's treasury yields, we basically have ourselves an inversion all the way from the 2-year to say the 10-year treasury yield. And when there is an inversion on the yields themselves, they do indicate that a recession is coming up. On top of that, I've said it many times, we've had 2 negative quarters of GDP. Our unemployment is under 4% and our inflation rate is above 4%. Do I see a recession coming in the future, regardless of whatever soft landing the Fed is going to attempt to do? I do. And if we're kind of looking at this, an inverted yield curve has predicted the past 7 recessions. Take a look. Recession, 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 recession. Look where we're at today. I honestly see that it's going to be a recession coming up. So that's good for you home buyers. Even if you're in the market right now to buy, you might be paying a higher interest rate. But as I'll say again towards the end of this video, honestly, there's enough inventory out there. We have returned into a buyer's market to where you're not going to have to fight for the home of your dreams or fight for a home that we saw a year and a half ago. Days on market have been up too as well. So buyers, just understand when you come in this, price reductions are happening on active listings all throughout the Treasure Valley. Plus, even in negotiations, we could maybe negotiate for a little bit more, but concessions have also returned to the Treasure Valley. So you can get things like your closing costs potentially picked up from the seller. So this is a good time to buy. It's a good time to get the home of your dreams. It's a good time to be able to get those concessions and apply them to practical things that you want to apply them to. And then on top of that, I do anticipate that the recession is going to hit. So until the effects of the recession actually hit, there's going to be some pain in that interest rate. But when it does and those rates come back down, you'll be able to go ahead and refinance for practically free, and you'll get the best of both worlds. So you'll get the home of your dreams, plus you'll be able to reduce the interest rate once the effects of the recession hit. And then you get, again, the best of the both worlds as you're saving money on your mortgage. But just want to go ahead and map this out one more time as we are taking a look here at the 2-year yield compared to, like, say, the 10-year treasury yield. We do see that inversion. And when most economists look in terms of, and most investors go out there to invest, they are looking at the 2 and the 10-year treasury yield and even the 3-month treasury yield in itself. So we are seeing signs that a recession is still on the way. And I honestly, personally do not think the Fed has what it takes to be able to go ahead and stave off from the recession. I do not see a soft landing, but we'll have to wait and see. Well, thank you very much, everybody, for taking the time out of your day to watch this video. I do hope that you found all the information on the weekly mortgage update that I do come out with very useful. So buyers, is this potentially a time not to buy because of where the interest rates are at? Well, as I've been kind of saying over the weeks and in prior videos, especially the one that I did have with Matt Pfeiffer from Axia Home Loans, I think that this is an incredibly good time to buy. Now, is that some sort of a realtor trick to get you out of your seat to come on out and buy here, say, and make that relocation to the Treasure Valley or buy right within here in the Treasure Valley? No, it's not. And here's why I come up with this reasoning. Well, first off, of course, we know that inventory is at levels that we have not seen since 2019. We also know that the days on market are way up comparatively. We also know that price reductions are happening on houses, on active listings all across the Treasure Valley. And we also know that we have returned into a buyer's market, and we have seen concessions actually return too as well in order for sellers to be able to go ahead and sell their home. So what does that mean for you as a buyer? What that means is that you can actually go out and find the home of your dreams and really not have to fight for it like you did a year and a half ago, and more or less, pick up whatever inventory was available at that time. Now you have options, and considering that it's a buyer's market, you have options to negotiate and get the seller's concessions that you're looking for. Now, as I did point out, throughout this data that I pointed out, just a little bit earlier ago, do I think the Fed has what it takes to be able to stave off and more or less create a soft landing as compared to seeing effects of a recession? I do not see that. I see effects of a recession taking hold. And as we have talked about many times in many other videos, when a recession hits, historically the rates will come back down. So even if you were to buy today, or say maybe even in the next couple of months, before the effects of the recession really hit, you'll be able to go ahead and refinance practically for free. And not only did you get the house that you're looking for, the house of your dreams, but then you can also reduce the rate, which is going to go ahead and save you money in the end. So of course, if you are looking to buy, sell, or invest in real estate right here in the Treasure Valley, please feel free to reach out to me today. I can be reached at 208-715-STAR. Again, that's 208-715-7827. And of course, if you're looking to begin your home shopping experience today, please feel free to visit my website at www.yourstarrealtor.com. Also, if you're looking to relocate in from out of state, please click in the description below, download my free relocation guide, so that way you're in the know before you decide to make the move. Also, please hit that subscribe button below, hit the notification bell so that you're constantly in tune with all the videos that I do come up with in the future. Well, thanks again, everybody, very much. I look forward to the day that we speak. Look forward to the day I call you my neighbor. God bless. Until then, thank you so much. Bye-bye.